Welcome, everyone. When we think about business, our minds often jump to the big, flashy ideas, right? We think about marketing strategies, disruptive innovation, global supply chains. But what if I told you that every single one of those big ideas, every success story, every corporate failure, every critical decision, it all boils down to one simple, fundamental action? Well, today we're going to zoom all the way in on that one action. We're talking about the very first building block of business and finance, the transaction.
I want you to really think about this for a second. A company, this legal entity we talk about, it can't actually speak. It doesn't have a voice. It can't tell you its own story, its struggles or its triumphs with words. So how does it communicate? How does it tell investors, managers, and you, hey, this is how I'm doing, this is my health, this is what I've been up to?
It speaks through the language of accounting. It's really the universal language of business. And just like learning any new language, you don't start with writing complex poetry or reading classic novels. No, you start with the absolute basics, the alphabet, the first words. And in the language of business, that first, most fundamental word, the atom that every complex story is built from, is the transaction.
So let's begin our formal analysis here. It's absolutely crucial that we approach this with precision. The metaphor of building a structure is perfect for this. If a company's financial report is a giant skyscraper, then each transaction is a single cornerstone. If you have any flaw, any crack in that first stone, you risk the integrity of the entire structure you build on top of it.
Okay, let's break this definition down because every single word here has significant weight. First, any event that affects the financial position. This is key. An event has to cause a measurable change in what the company owns or what it owes. Think of it like a perfectly balanced scale. A transaction has to tip that scale or at least move things around on it. Maybe assets go up, but then liabilities go up too, or maybe you trade one asset like cash for another asset like inventory, keeping the scale perfectly in balance. Second, it must have monetary value. This is a bedrock principle of accounting. We can only record what we can reliably measure in a currency, dollars, euros, whatever it may be. A brilliant new idea from an employee might have immense value, but until you can measure it in dollars, it's not an accounting transaction. And finally, the implied action here, it must be recorded. This is the official act of documenting the event in the books, creating a permanent piece of the company's financial history.
Let me be perfectly clear on this point. The big reports you've heard about, the income statement, the balance sheet, the statement of cash flows, they're nothing more than summaries. They are the aggregation of thousands or even millions of these individual building blocks. The statements are the final output, but the transaction is the fundamental input. So mastering this concept isn't just important, it is the absolute prerequisite for any meaningful financial analysis you will ever do.
All right, now that we have our solid definition of what a building block is, let's look at the different kinds of blocks we have to work with. Just as a builder uses different materials for foundations versus windows, accountants classify transactions to understand their specific job, their specific impact on the business. And these transactions mainly fall into three distinct categories. These three categories really represent the core activities of any business you can think of. First, you have revenue transactions. These are the inflows, usually cash, that you get from delivering your goods or services. This is the lifeblood of the business. Then you have expense transactions. These are the costs you have to incur to generate that revenue. And the relationship between revenue and expenses, well, that's what tells us if the business is profitable. And finally, we have investment transactions. Now, these are different. These are about buying long-term assets or getting capital from owners. These transactions aren't about today's profit. They're about building the capacity to earn more profit in the future. So let's make this real.
Let's forget the abstract theory for a minute and step inside a business we can all picture, a local coffee shop. Every single day, that shop is a whirlwind of activity, a whirlwind of transactions, and each one is telling a tiny part of its financial story.
So you walk in and buy a latte. What just happened? The coffee shop delivered a product, fulfilling its promise to you, the customer. In exchange, it received an asset, your cash. This is a classic revenue transaction. It represents the value the shop created, and it's the primary driver of its income statement.
But wait, to make that latte, the shop had to use things up, right? It used milk, it used coffee beans. Those are costs of goods sold. And it had to pay the barista who made it for you. That's a salary expense. The matching principle in accounting says we have to record these expenses in the same period as the revenue they helped create. Why? Because that's the only way to get a true picture of whether that one latte was actually profitable.
Now, what about the big, fancy espresso machine behind the counter? Buying that machine is a totally different kind of transaction than buying a carton of milk. You see, the cost of the milk is expensed right away. But the cost of the machine is capitalized. That means it's recorded as a long-term asset on the balance sheet.
And the reason is simple. That machine is going to help make lattes and generate revenue for years to come. It's a long-term resource, so its cost is gradually recognized as an expense over its useful life through something called depreciation. This is an investment transaction. It's about building the future of the business.
So we know what the blocks are, and we know the different types. But how do we decide if an event even qualifies to be a block in the first place? Well, for that, we use a very strict three-point inspection. And this isn't just a list to memorize. I want you to think of this as a quality control checklist that every single event must pass without exception.
This really captures the disciplined, rule-based nature of accounting. There's no gray area here. An event either meets all three criteria and gets recorded, or it fails even one of them and stays outside the formal accounting system. It might be a hugely important business event, but if it doesn't pass this filter, it is not an accounting transaction. Not yet, anyway. Let's really drill down on these. First, monetary value. Can we put a reliable dollar amount on it? Simple when cash is involved, trickier in other cases, but it's non-negotiable. Second, it must affect the financial position. This goes right back to the fundamental accounting equation. Assets equals liabilities plus equity. For an event to be a transaction, it has to cause a change in that equation while keeping it in balance. And that leads to our third test. It must change an accounting element. What are those? Assets are resources the company controls. Liabilities are obligations to others, and equity is what's left over for the owners. A transaction must impact at least one of these categories. For example, buying supplies with cash decreases one asset, cash, but increases another asset, supplies. The equation stays perfectly in balance.
Okay, time for a practical test. This is a classic scenario that often trips up students when they're first learning this. Let's say our coffee shop finds a fantastic new manager. They sign an employment contract today, and the manager is going to start on the 1st of next month. Now, this is clearly a huge, important business event, but the question is it a recordable accounting transaction at the moment the contract is signed?
The answer is a definitive no. And this highlights a critical distinction between a business commitment and an accounting transaction. Let's run it through our three-point inspection. 1. Does it have monetary value today? No. No money has changed hands. 2. Does it affect the financial position? No. The company's assets and liabilities are exactly the same as they were before the signing. This is what we call an executory contract. It's just a promise of future performance on both sides. The actual transaction will happen later, at the end of the manager's first pay period. At that point, they've provided a service, the company has incurred a liability, wages payable, and only then does the event pass all three tests and get recorded.
So far, we've been looking through a microscope, focusing on the individual transaction. Now, I want us to zoom out. Let's pull back to the macroscopic level to see the ultimate purpose of all this detailed record keeping. We're moving from looking at individual building blocks to looking at the complete architectural blueprints of the company.
Think about the flow of information. Every single transaction, every latte sold, every bag of beans bought is first recorded in a journal. From there, the data is organized into a general ledger. At the end of the month or the quarter, you take the balances from that ledger and you use them to construct the financial statements. So the total revenue line you see on an income statement, that's just the sum of thousands of individual revenue transactions. It all rolls up.
And these final statements, these blueprints, they are the single most important tool for decision-making. A manager looks at the income statement to see which products are most profitable. A banker analyzes the balance sheet to decide if the company is a good credit risk. An investor studies everything to determine what the company is actually worth. Every single one of these critical decisions relies on one simple assumption, that the thousands of tiny blocks at the foundation were recorded accurately and consistently.
So, to wrap this up, let's go back to where we started. If you want to become fluent in the language of business, you have to master its fundamental grammar first. The transaction is that grammar. A deep, conceptual understanding of this one element is the bedrock upon which all of your future financial knowledge will be built.
In the end, accounting isn't really just about numbers on a page. It's about telling a story. Each transaction is a single sentence, and when you put them all together, they form the narrative of a company's journey, its struggles, its growth, its ambitions. So the real question for you as you move forward in your careers is, what story will you help build?